As we're now almost halfway into 2024, global asset markets continue to be driven largely by macroeconomic events, with key focus on the uncertain trend of disinflation, expectation of monetary policy settings, and the resiliency of the overall economy. In our early updates, we commented on the fact that previous expectations of rate cuts were overly optimistic, with 6 to 7 cuts priced in 2024. Since the upside CPI surprise in April, market expectations have repriced significantly lower, to merely 1 or 2 cuts later this year. This delay in rate cut expectations was on the back of reflationary pressure that we have seen in recent economic releases, with an expansionary manufacturing sector, resilient labor market, and strong rises in commodity prices and an elevated fiscal spending near recessional levels. These reflationary conditions have led us to believe that pro-cyclical equities will likely to be the beneficiary, with economic growth remaining resilient and offering a generous margin of safety with valuation at discounted levels. On the other side, sticky core inflation and record level of fiscal spending have led investors to demand a higher risk premium on bond yields. With the larger upside movements on bond yields, we've seen a volatile second quarter in the growthy part of the equity markets. We remain cautious on the growth sector due to 2 major risks. First, the highly anticipated earnings are vulnerable to potential disappointments. And second, upside risk to discount rates can quickly adjust valuation multiples downwards. We emphasize that price you pay for an asset will drive your long-term return. Over the last quarter, we've increased our exposure to global quality small companies. While we're seeing a positive sign in the aggregate economy, the increasing level of consumer credit continues to suggest that caution is warranted. Therefore, we prefer companies with strong balance sheets, defensive cash flows, and pricing power. These type of companies should be able to bear the brunt of higher rates and weaker demand. But going back to our first principle, we're not willing to overpay for these qualities, hence avoiding the larger caps and finding small to mid-cap companies with similar attributes at a much lower asking price. In addition, we continue to hold an underweight in treasury bonds, which have protected our clients from the heightened volatility in the fixed income market. We continue to see rates staying higher for longer, and given the recent reinflation spike, the risk premium for bonds are likely to persist. However, unlike inflationary shocks, a growth shock will have equities and bonds potentially negatively correlated again. Hence, to hedge our cyclical exposures, we hold a mild but underweight bond position to protect our portfolio from a growth shock scenario. To summarize, the outlook for macroeconomic conditions for 2024 is highly mixed, and we think further divergence across regions and sectors are likely in the next 18 months. And therefore, investors should be selective, and asset allocation positioning should be treated with caution. Given this degree of uncertainty, we're more diversified in our portfolios than usual, and slightly more defensively tilted compared to our benchmarks, with a focus on regional resiliency and valuation discipline.